Welcome back. In this video, we will explore and apply volatility-adjusted returns to derivatives volatility indices. As we have discussed throughout this course, volatility indices have unique characteristics. While they offer several trading opportunities, they also come with inherent risks. To truly understand your trading performance, it's essential to look beyond potential profits and consider the risks you are taking to achieve those returns. Volatility-adjusted returns provide a more comprehensive view of your trading performance by factoring in the level of risk you have exposed to. This metric allows you to compare strategies across different market conditions. Let's break down the key concepts. Raw returns. These are your profits or losses, typically expressed as a percentage. For example, if you traded $1,000 and ended up with $1,100, your raw return would be 10%. Volatility. Remember, this measures how much and how quickly the price changes over time. Higher volatility means more dramatic price swings and potentially higher risks. Volatility-adjusted returns. This metric adjusts your raw returns based on the level of volatility you have exposed yourself to. It's often expressed as a ratio commonly known as the Sharpe ratio. The Sharpe ratio is calculated as follows. Sharpe ratio equals to return minus risk-free rate divided by the standard deviation of return, where return is your strategy's average or expected return. Risk-free rate is the return of a risk-free asset. Traders often use the interest rate on a US Treasury bill. Standard deviation of returns measures the volatility of your returns. A higher Sharpe ratio indicates a better risk-adjusted performance, meaning you are getting better returns for the risks you are taking. It shows how much extra return you are earning compared to a risk-free investment, considering the asset's extra ups and downs, also known as volatility. Let's consider an example where you're using the same mean reversion strategy on both the volatility 10 and volatility 100 indices. After testing this strategy on the demo account, you calculate the average annual returns for each index. The next step is to evaluate the Sharpe ratio for both, assuming a risk-free rate of 2%. Strategy A on the volatility 10 has an average annual return of 15%. Annual volatility 10%, risk-free rate of 2%. Plugging these values into the formula gives us a Sharpe ratio of Sharpe ratio equals to 15% minus 2% divided by 10% equals to 1.3. Strategy B on the volatility 100 has an average annual return of 25%. Annual volatility 100%, risk-free rate of 2%. Inputting these values into the formula given to us as a Sharpe ratio of Sharpe ratio equals to 25% minus 2% divided by 100% equals to 0.23. Note the significant difference in the Sharpe ratios due to the varying levels of volatility. Strategy A's Sharpe ratio remains at 1.3, reflecting better risk-adjusted returns given the lower volatility of the volatility 10 index. Strategy B's Sharpe ratio drops to 0.23, indicating substantially poorer risk-adjusted returns because of the extreme volatility associated with the volatility 100 index. This contrast in Sharpe ratios highlights the impact of volatility. Strategy A's Sharpe ratio of 1.3 reflects better risk-adjusted returns due to the lower volatility of the volatility 10 index. In contrast, Strategy B's Sharpe ratio drops to 0.23, showing much poorer risk-adjusted returns because of the more intense fluctuations of the volatility 100 index. The volatility 100's higher price swings introduce greater risk, which overshadows Strategy B's higher raw returns. While evaluating Sharpe ratios, it's also important to consider risk management. Effective risk management is essential, especially if you still decide to trade Strategy B given its higher risk profile. This involves carefully using stop-loss orders and precise position sizing to mitigate potential losses. Trading costs. Spreads and overnight fees can significantly impact performance, so factoring these into your trading strategy is essential. Leverage. Volatility 10 uses a leverage of 1 to 5,000, while Volatility 100 uses a lower leverage of 1 to 1,000. Although the lower leverage for Volatility 100 seems more cautious, it still presents substantial risk due to its high volatility. While volatility indices can offer attractive returns, assessing the associated risk is crucial. Understanding volatility-adjusted returns provides a clearer picture of trading performance and helps guide you towards a more balanced, risk-aware strategies. By analyzing these metrics, traders can identify which indices offer a better balance between potential returns and risks, aligning with their individual risk tolerance and trading goals. Thank you, and happy trading.